Hey guys, welcome to another episode of Zach's Credit Card Guide. Today we're going to go back to the basics and talk about how your credit score works and what goes into it. If you are new to the channel, we do a lot of credit topics, card reviews, and redemptions, so make sure to hit that subscribe button, but let's get started. So there's four categories that we're going to talk about today for what goes into factoring your credit score. Those four things are inquiries, your overall credit history, your utilization rate, and the types of credit that show up on your profile. Now the first factor we're going to talk about are inquiries. Now these have a fairly small impact on your score and only account for about 10%. Now generally there are two types of inquiries that can show up on your credit report. These are commonly called hard and soft inquiries. Now hard inquiries are the ones to be, I don't want to say concerned about, but be mindful of. And these happen when you actively seek new credit. So let's say, for instance, you go get a new car loan, line of credit, or credit card. The financial institution is going to check your credit report in their lending decision. And that check, that inquiry, is what will show up. Now these can temporarily drop your score for a few months by 2 to 4 points on average each. Now if there are multiple hard inquiries in a short period of time, there can be sort of a compounding effect. So just keep that in mind. If you're seeking a lot of credit rapidly, that can have an adverse effect on your score. Now the second type of inquiry is a soft inquiry. Now generally these have no effect on your score. These can show up, for instance, if you check your score yourself on Credit Karma, or if you use the cardmatch.com tool to look for special offers. Those do not have an impact on your score, and it's a common myth that checking your score will affect it. It won't. The other times a soft inquiry can show up is maybe a background check if you applied for a new job, but also with American Express specifically, for existing customers, sometimes they will only do a soft pull. Now the next category we're going to talk about is your credit history. Now this really is broken down into two categories, payment history and then your overall credit history. The first one we're talking about is payment history that accounts for about 35% of your score, so this part is very important. Now it's fairly self-explanatory. How often do you make your payments on time? Now even one missed payment can have a relatively high effect on your score, so it's very important to always make payments on time. Now one, maybe two, is not going to be the end of the world, and as long as the rest of your credit profile is in good shape, it shouldn't have an enormous impact, but it will have an impact. So again, it's very important to always make payments on time. Now as far as credit cards, we are talking about the minimum payment due. As long as you make that on time by the due date, you're going to be fine. Now on this channel, I recommend always pay off all of your accounts in full every month. Never carry a balance. Now sometimes there are 0% intro APR on certain cards, and if you're an adult and you can handle that, then really there's nothing wrong with that. It's interest free. Just be careful not to dig yourself into a hole you can't get out of. So again, you're an adult, be strategic, but by and large, please pay off all of your accounts in full every month. Never pay any interest, because then any rewards that you might gain are negated by that interest payment. And kind of a pro tip, if you aren't good about managing multiple cards, then just set up automatic payments on them, so that worst case, that kind of is a safeguard from a missed payment. Now kind of the second part of history is just your overall credit history. Now this only accounts for about 15% of your score, but it is still very important. And mostly what issuers are looking at is your overall credit history and kind of your average age of accounts. And simply what that means is just like what it sounds. What is the average of how long your accounts have been open for? Now of course longer is always better. Basically what this is when issuers are looking whether or not to give you a new loan, a new credit card, they want more data. More data is always better to get a better picture of who you are. Do you make your payments on time? Are you good at managing credit? Now the longer you've been managing credit well, gives them more data to look at. So let's just take, for example, someone who has two cards and they've both been open for about 5 years. So right now their average age of accounts is 5 years. 5 years plus 5 years is 10 divided by the two cards. Their average age of account is 5 years. Now let's say they go and apply for a third one and get it. Now their average age of accounts goes from 5 years, 5 years, and 0 years. So now the average goes down to about 3 1/3. So as you can see, the fewer accounts that you have, each new one will have a larger overall impact on your average age of accounts. And then on the opposite side, once you have more cards, each new one will have less of an effect. And this comes to my second pro tip: never cancel a no annual fee card if at all possible. And if you do have a fee paying card that you're not getting value from anymore, see if you can downgrade it to a no annual fee version. Many times that is possible. And what that allows you to do is keep all of that good history from that account, but now you don't have to pay an annual fee if that's something you're worried about. So always look into that. One example is, say, the Chase Sapphire Reserve. Comes with a $450 annual fee. Very easy to get that back, but let's say for whatever reason life changes and you don't want that card anymore, you can downgrade it to, say, the Freedom Unlimited, and now you keep that account open, keep all of that good history, but now you're not paying an annual fee. If the card already has a no annual fee, say for instance the Chase Freedom, then you don't have to worry about it. There's really no reason to ever close that card because it's only helping you. Now the next thing we're going to talk about is your utilization rate. In short, this is your total revolving credit used as a percentage of your overall credit available. And lower is going to be better here. So for example, let's take Bob. He has 6 cards with a $4,000 credit line on each card. And because we're talking about Bob's overall credit, it doesn't matter what issuers they're from. They can be one from each. It doesn't matter because we're looking at his total credit available. And let's just say for easy math, Bob has exactly a $700 balance on each of his 6 cards. So that means he's currently using $4,200 in credit of his available $24,000 credit line across all of his cards. So that makes his utilization rate 17.5%. Now again, lower is always better with your utilization rate. Some folks will say target 30% or lower. I personally like to be a bit more aggressive. I like to say stay under 10% at all times. Now, how do you manage your utilization rate? This is, of course, one of the factors that you have the most direct control over. And really, once you have sufficient limits across all of your cards, it really is a non-issue. This is going to affect you most when you're first starting out and you only have 1 or 2 cards, and with that, kind of low limits overall. So your rate will likely be higher when you're first starting out. And again, that's fine. There's really nothing wrong with that. Your score might dip a little bit, but it will improve as you add more cards. Now, in the short term, if you don't want to add more cards, you can see if the issuer will give you a credit line increase on one of the cards you already have. And that will have virtually the same effect because now instead of here, you go to here. If you keep the balances the same and just have more credit available but don't use it, then of course your rate is going to go down. So as always, strategically apply for new cards and or credit limit increases to manage your utilization rate. Now the last one we're going to talk about is your credit mix, and this accounts for about 10% of your score. And this is when the lender is looking at what types of credit do you have experience with, and they like to see a healthy mix. So some common ones that they look at are revolving credit lines. Now these are typically credit or charge accounts, or even just a basic line of credit through a financial institution. So think of revolving credit as something with a credit line. So again, like a credit card or something like that. They'll also look at any installment loans. Now these are typically for a fixed term and a very specific thing. So the most common one that people will probably see is like a car loan, maybe a student loan, just something where it has a finite time period and a fixed payment each month. And then last, they might look at mortgages if you have one. And again, what all of this does is show that you can manage different types of credit. Now, kind of a bonus tip for those first starting out, that your score might be a little bit more volatile just because you don't have a lot going on yet. Experian just rolled out a new program that they're calling Boost. And in short, what it does is if you give them limited read-only access to your checking account, they will factor some of your utility payments into your score. And it basically just gives you credit for making on-time payments for other bills, which does kind of make sense, and I'm glad they're doing it. I personally have not taken advantage of it, one, because I don't think it'll really matter. My file is pretty healthy enough, but also, two, I don't want to give Experian that kind of access to my checking account, especially these days with so many data breaches. Again, I just don't personally think the risk is worth it, but it is something you can explore if your credit file is a bit thin. So that's all I've got for you this time, guys. This was a quick video on how your credit score works and what goes into it so that you can make better financial decisions. My question to you guys is, did you know about this? Did you already know how your credit score works? Or what was one thing that surprised you, if anything? Let me know down in the comments. But otherwise, if you guys have any other comments or questions, please do leave them down below. I tried to get to every single one. Find me on social media so you can stay in touch, but most importantly, guys, hit that subscribe button so you don't miss any future videos. That's all I've got for you this time, guys. See you at the next one.